Mutual funds and exchange-traded funds are the two main categories of funds you'll encounter while searching to invest. Mutual funds and exchange-traded funds, or ETFs, can provide your portfolio with several advantages, including low-cost, immediate diversification. But there are also significant distinctions, most notably in how pricey the funds are. If you want to know which option is better for you, watch the video until the end. Hello one-on-one community, welcome back to our YouTube channel. In this video, we will explain the differences between ETFs and mutual funds. But before we begin, if you're new here, make sure to subscribe to my channel and turn on notifications to never miss any updates. So let's start. An exchange-traded fund, or ETF for short, is a type of investment fund that enables you to purchase a single purchase of a variety of individual stocks or corporate and governmental bonds. Think of ETFs as financial wrappers, similar to the tortilla that holds together the elements of a burrito. These burritos are filled with stocks or bonds and are far less satisfying to eat with salsa. A mutual fund gathers money from investors and pools it into a fund. It is one investment vehicle that can help you diversify your funds. These funds invest in various products, including short-term debt, bonds, and stocks. Mutual funds let experts choose your specific stocks, bonds, and other investments. This makes mutual funds a perfect choice for investors who prefer to take a backseat. Choose a stock market sector, and a mutual fund to assist you in investing in it is sure to exist. Mutual funds provide such exposure, whether you want to own only the largest or smallest US stocks, invest in China or South America, or want the safety of bonds or the income from real estate without having to physically own either. Benefits of investing in ETFs. Diversification. You may effectively diversify your portfolio with ETFs without choosing specific stocks or bonds. They provide a wide range and cover most key asset classes and sectors. Lower cost. All managed funds have operating costs. These expenses consist of distribution fees, administrative fees, marketing expenses, custody fees, and fees for portfolio management. Costs have historically played a significant role in predicting profits. Generally speaking, the projected return for a fund is higher the lower the cost of investment is. Compared to open-end mutual funds, the costs associated with operating ETFs are lower. The brokerage companies that store the exchange-traded assets in customer accounts incur client service-related fees, which results in lower costs overall. ETFs also feature lower costs for monthly notifications, statements, and transfers. Shareholders must get statements and reports from traditional open-end fund companies regularly. The lack of mutual fund redemption fees is another cost-saving benefit of ETF shares. ETF shareholders are exempt from the short-term redemption costs that some open-end funds impose. Liquidity. Since ETFs are traded on exchanges, you can buy and sell them at any time of the day. In other words, investors can swiftly and fairly sell an ETF to collect their profits. In comparison, investing in something like a house can be viewed as less liquid because it would take longer to find a buyer. You might have to accept a substantial discount if ever you need to sell it quickly. ETFs are a helpful tool for investors wishing to quickly enter or exit. Disadvantages of investing in ETFs. Low trading volume. The more trades that happen inside an actively managed ETF, the more predictable the price may be. Additionally, a higher trading volume may increase the ETF's liquidity, which is advantageous. The bid-ask spread may be greater due to the low average trading volume of ETFs, so investors may not receive the price they anticipated. Investors can determine whether an ETF will satisfy their needs by looking at its typical trading volume before making a purchase. Currency risk. If you have invested in ETFs abroad, there is currency risk associated with the US dollar value. the volatility of funds with exposure to emerging markets may also increase. If the fund you invest in is located outside of America, you can even be hit with foreign taxes. It is always best to conduct research, take into account your individual circumstances, and weigh your tolerance for risk before making any financial decisions. Lower dividend yields. When compared to owning a company or group of stocks with a high yield, certain ETFs pay dividends, but their yields might not be as high. While stocks can offer much higher dividend yields if an investor is ready to take on the risk, ETFs frequently have lower risks. Even if you have the option to select the firm with the highest dividend yield, the average yield will be lower for ETFs because they track a larger variety of stocks. If you like the video so far, press the like button and subscribe to the channel. Also, if you want to develop yourself financially and want to take your future into your own hands, check the links in the video description. Let's move on. ETF versus mutual funds. Strategy. All funds are made up of various securities that are bought and sold in an effort for the fund to achieve its investing goals. Most mutual funds that are actively managed are aiming to outperform market indices. Fund managers research the market and rely on their extensive financial knowledge and experience to maximize their performance. Although managers of mutual funds typically have some options in selecting the investments they believe will perform best, they must offer investors a fund objective and a roadmap to a particular investment style. In contrast, passive funds aim to align their performance with a recognized market index, such as the S&P 500 or FTSE 100. The degree to which a passive fund duplicates a certain index is a gauge of its performance. This group includes index funds and the vast majority of ETFs. Trading. One distinction between mutual funds and ETFs is how the funds are traded, which has some ramifications for investors. The closing price of the day's trading day, or the NAV, which stands for net asset value, is used to buy and sell mutual funds directly from the mutual fund company. ETFs may cost slightly more or less than NAV and are traded throughout the day at the current market price, just like stocks. While certain ETF trades contain brokerage costs, mutual fund transactions do not. Trading fee. Investors should be aware of two types of fees in any fund: transaction fees and fees incorporated into the fund's expense ratio. Transaction costs for mutual funds may include sales loads, also known as sales charges, or redemption fees. Investors owe them money directly. Like stock trades, ETF transactions may also involve brokerage commissions paid by the investors. The expenditure ratio calculates a fund's operating expenses by the average dollar amount under management after the fiscal year. The expense ratio is determined yearly and disclosed in the prospectus for the fund. The fee paid to the fund managers, or the management fee, typically makes up the largest and most unpredictable portion of these costs. Custodial services, record keeping, legal fees, acquired fund fees, and expenses if the fund invests in other funds, accounting and auditing fees, or a marketing fee are some other components of these running costs, called a 12b-1 fee. Operating costs are deducted from the fund, reducing the return to investors. Generally speaking, active investment funds will incur higher running expenses than passive investment funds. Due to the wide variance in costs among funds, investors should take time to learn all about the expenses related to any potential funds they wish to invest in. Tax implication. ETFs are typically designed to protect investors from paying capital gains taxes. Currently, almost all ETFs are index funds. As such, they trade in lower volume when compared to actively managed funds. That typically results in lower taxable capital gains for fund investors. This is similar to index mutual funds. What connection exists between taxable capital gains and fund turnover? Investors purchase and sell ETF shares with other investors on an exchange, which is a significant distinction between ETFs and mutual funds, active or index. As a result, the ETF management is spared from liquidating holdings to cover investor redemptions, which could result in capital gains. Shares of mutual funds can be redeemed directly by shareholders. While ETF shareholders may pay tax implications when selling shares on the market, certain traditional mutual funds may be tax efficient. This tax penalty is not shared by other ETF shareholders. Conclusion: given their differences, which of the two types of funds is preferable for you? It varies. Each can meet particular demands. Mutual funds are frequently a smart choice for investing in specialized markets, such as stocks of smaller overseas companies, and complicated but potentially lucrative sectors like market-neutral or long-short equity funds with arcane risk-reward ratios. But ETFs, with their combination of low prices, liquidity, and diversification, may hold the advantage in most cases and for most investors who wish to keep things simple. Suppose your goal is to build long-term wealth with a balanced, widely diversified portfolio. In that case, they are helpful instruments because they can give you direct exposure to several market segments. That's all for today's video. I hope you enjoyed it. If you want to see more videos like this, subscribe to our channel and click on the bell icon so you'll be notified of every update. And don't forget to check the links in the video description. And while you're here, click to watch one of these 2 videos appearing on your screen right now. I'll see you there. Take care and stay tuned.